Good morning, everybody. Welcome to Credit Academy. Today, our topic for discussion would be the beta. Today we would be discussing what is beta, and I would try to explain beta in a very simple layman term so that we can understand it is in a very simple term. Next, after that, we would be showing how it is calculated. Then, why beta is calculated? What are the potential uses of beta? And lastly, we would go into calculating cost of equity, which will be calculated using the capital asset pricing model. So, as you all are aware, is the stock markets or any financial markets work on the concept of risk return trade-off. What does it mean? It means that if higher is the risk, higher would be the return expectation. So I would require a return which is substantially higher if the risk of that particular asset or securities is substantially higher. And how risks are measured? Risks are measured in financial terms by volatility, which is higher the volatility, higher would be the risk. Now, what is beta? Beta, according to definition, is the sensitivity of a particular security movement with respect to the movement of the overall market. For the purpose of this class, we will assume that Nifty is the overall market, and when we say the movement of the market, we would be uh, only looking at from the perspective of the Nifty movement. That is, the return for the market and the return of the Nifty are one and the same thing as far as this class is concerned. So again, beta means what? The financial elasticity of a particular security with respect to the market, which in our case is defined as Nifty. Now we'll do show it from this one. Say we'll draw this chart where the horizontal axis we are representing time and the return. Suppose the movement of the Nifty over last 1 year, 2 year, 3 year, 4 year is this one. Correct? Now, what would be the beta of the Nifty? How do you calculate it? Beta of the Nifty is nothing but the movement or the sensitivity of the movement of the Nifty with respect to itself. So the sensitivity would always be equal to 1, because in this the market movement and the Nifty movement or the beta of Nifty would always be 1. Okay. Now take any other security whose movement is similar to Nifty. That is, whenever the Nifty goes up, the security also goes up. Whenever the Nifty goes down, the securities also goes down in the same proportion. So in this case, I'll say, for example, if this stock is R, I'll say that the sensitivity of this movement of the R stock is also 1, because if the Nifty moves up, then the R security also moves by 1%. So here we will say that the security R has a beta of positive 1. That means that if Nifty moves by plus 1%, R also moves by plus 1%, and Nifty moves by minus 1%, R also moves by minus 1%. Now consider another stock whose movement is more volatile or wide than the Nifty, which is plotted using the blue line. Suppose this stock is S. In this, what is happening is that the stock S is moving in a more volatile fashion than the underlying Nifty. So the volatility of the stock is higher. Say suppose if the Nifty is moving by 1%, the stock is moving by say plus 3%. And if the Nifty is minus 2%, the stock is moving by minus uh, three times that is minus 9%. So in this case, the direction of the movement of the stock and Nifty is same, but the magnitude of the movement of stock S is three times the movement of Nifty. So in this case, we will say that S has a beta of 3. Now take one more example. This black line shows the movement of Nifty. Suppose there is one stock whose movement is less volatile than the movement of the Nifty. That means that if Nifty is moving by 2%, that stock is moving by less than 2%. So in this case, we will say that this stock, which is represented by green line, say G, the beta of the stock G would be less than 1. So what are we coming into? That beta in very simple term is the sensitivity of a particular security with respect to the movement of the market. Again, if we say that beta of a particular script A is 1, it implies that if Nifty moves by 1%, the stock also moves by 1%. If the Nifty move by minus 3%, the stock also moves by minus 3%. So if I'll say that the beta of a particular security B is minus zero point 0.5. What does it simplify? That if Nifty moves by 1%, the beta here mind, this is a negative beta. So the stock will move in opposite direction, but the magnitude is only zero point 0.5 or half. So in this case, the stock will move by this one. Suppose for the same security, having a beta of minus zero point 0.5 in this case B securities, if the Nifty moves by minus 2%, then the expected movement from the stock B is positive 1%. So one is that beta shows us the direction of movement of a particular stock with respect to Nifty, and second is magnitude of the movement of the stock with respect to Nifty. Okay, now we'll just take some quiz. What is the beta of cash? What is the beta of cash? So what needs to be done? That we need to predict the movement of cash with the movement of Nifty. Suppose if the Nifty moves by 2% positive, does my cash lying in the portfolio move? No. Or take the reverse, that if the Nifty crashes by 5%, my cash remains the same. So in this case, we will say that the beta of cash is 0. Now, what is the beta of a portfolio in which I have only one security, which is I have shorted the Nifty? So, what would be the beta of a short position of Nifty future? If the Nifty moves by plus 1%, then my return by shorting Nifty would be minus 1%. And if the Nifty moves by 5%, then I would have a loss of 5%. That is, my return from the portfolio is minus 5%. So, can we say that the beta of short position in Nifty futures is minus 1? Now we will go to the next thing, is that how it is calculated. Beta is a regression analysis. In statistical terms, beta is calculated using the regression analysis where the beta for a particular stock A is the covariance coefficient of the return from the stock A, the return from the market divided by variance of the market. The covariance is nothing but a form of correlations wherein it shows the movement of a particular stock with respect to the movement of the market. So here it also shows the direction of the movement of stock with respect to market and the magnitude of the movement of the stock with respect to market. Here RA is equal to return of security A, RM is equal to return of market, and for our purpose it is Nifty. Okay. Now, what is the use of beta? We have identified that what is beta is in simple terms, and we can calculate beta also. But what are the uses? First uses of beta is to predict. See, suppose the beta of a particular stock, say Jayaprakash Associates, is 2. Beta of JP is 2. So here I can expect that the one is Jayaprakash Associates will be more volatile than the Nifty. And if I expect that the market is on an uptrend and market is expected to move by 5%, then my expected return from JPA should be 10%. That is 2 times Nifty return. Similarly, remember beta is a double-edged sword. If the same JPA have a beta of 2 and Nifty moves by minus 5%, then in that case the expectation of return from GPA is minus 10%. So we, depending on the beta of a particular securities, we can predict the movement of a particular stock with respect to any underlying movement in Nifty. Second, it also helps us in portfolio diversification. Ideally, I should not want to have a portfolio which is very risky. So I would have a portfolio wherein some stocks I would have a high beta and in some I would have a low beta. Also, if I am able to find any stock whose beta among themselves is negative, then it acts as an automatic hedge. That if one stock is going up, the other stock is going down. So it helps in my portfolio diversification and diversification of risk. One of the most widely used practical uses of beta is calculating cost of equity. We calculate cost of equity using CAPM model. We will discuss now in detail what is CAPM and how do we calculate it. In a moment, I will rub this. Yeah, we all know that higher the risk, higher should be my expected return. Correct? And if higher the volatility of the stock, higher is the risk, and my return from the sale is should be high. So, what does CAPM, which is Capital Asset Pricing Model, says? It calculates the cost of equity. Just before coming to cost of equity, uh, where this cost of equity is used. See, when we are doing a valuation, valuation can be absolute and valuation can be relative. In absolute valuation, we use DCF. DCF is the discounted cash flow. That is the sum of all my futures cash flow, that is cash flow I, where I is the period under consideration, divided by my cost of equity. This is I. Okay. So here the discounting factor is what? Discounting factor is my cost of equity. So if a stock is risky or more volatile, or if the stock has a higher beta, then my discounting rate also increases. So one of the practical uses of beta is finding the cost of equity, which is used in doing my DCF. That is for the purpose of pricing the equity valuations. Now we again come into the CAPM formula, where cost of equity is the risk-free interest rate plus beta of a security into expected return from the market and risk-free return. What is risk-free return? Risk-free return is where there is no risk as far as the principal repayment is concerned, and also the interest risk also is not there. That means that if I have got a security which promises me to pay 8% return, then I would be getting that 8% return year after year. So, in any country, we generally take the risk-free return as the return from a government security. Now, if I am considering a project or equity for say 10 years, I should use the rate of GSEC yield of 10%, 10 year. So this time frame should correspond with the time horizon of my investment or the project. Suppose that GSEC yield of 10 year in India is 8%. What is return on market? Return on the market is calculated on the basis of past data. We may take 10 years, 20 years depending upon the data availability and the relevance of the market. Say based on last 15 years data, the return of Nifty is 14%. Now we are calculating the expected return from Jayaprakash Associates, that is cost of equity for JPA. And if we take the same example that the beta of JPA is 2, then what should be my required rate of return for investing in JPA? It should be RF is 8% plus beta of 2 into return from market minus 8%, that is 20%. So given the riskiness of the GPA stock, given the volatility of the stock price of GPA, I should require a return which is much higher than risk-free return, and also a return which is higher than the Nifty return of 14%. because the risk for volatility of JPA is much higher than the market. So here my cost of equity for JPA is 20%. So what does it mean? That the actual return of JPA is 20%? No, this is our required rate of return, which is expected rate of return, or we'll say that our hurdle rate of return by investing in Jayaprakash Associates, which is historically more risky than the overall market. So that finishes our topic of beta, wherein we have discussed what is beta in also a layman term, what actually beta means, how it is calculated, what are the potential uses of beta, and one practical use of beta, which is there in arriving at the intrinsic value of a stock using DCF, where beta is used in calculating the cost of equity using CAPM method. Thank you.